Hey folks, welcome back to the channel. This is Jason, certified financial planner and host of Fighting Words Financial. I'm going to take a quick sip of my coffee here because I deserve it, especially after this morning and all of the panicked phone calls that I got and emails that I got, all the communications that I got from people through my YouTube channel, kind of panicking about the drop in the NASDAQ this morning. And I'm going to tell you guys kind of what I told them. And I don't have a speech planned out or anything, but let's talk about that right now. Emotions in this market, actually emotions in a market that's going straight up and emotions in a market that's going straight down, those are all bad for you. Emotions are not your friend when it comes to investing or financial planning. They just get in the way of making rational decisions. And all of that is amplified now by what's going on in social media and news. So the YouTube algorithm in this respect is not your friend, right? So I'm going to tell you kind of a message that's sort of counter algorithmic here, which is don't pay attention to the news right now, especially the news that's served to you via social media, via Facebook, via Google, via YouTube right now, because it's served to you for the deliberate purpose of manipulating your emotions and eliciting an emotional reaction. Because the people that design those algorithms work with advertisers, and they know that that is the way to keep you engaged, that is the way to keep you watching, that's the way to keep you listening, that's the way to keep you reading, is to elicit an emotional reaction, which is the exact opposite of what you need in order to make rational decisions about stocks. So I'm going to make a kind of a really bold prediction right here that the correction that we're seeing right now in the NASDAQ is basically over. Okay, it's already happened. It's basically over. We've hit bottom. We may see some choppy trading here over the next 2-3 months, but the gut-churning drops in prices have pretty much stopped at this point, and the market is closer to where fundamentals are intersecting with reality. Okay, so let's talk about that for a second. The big worry right now is interest rates. Are interest rates going to rise? Are we going to see inflation? The answer to both of those questions is yes. And the real thing to understand about that is neither I or any other financial professional in the industry right now is really tremendously concerned about this. Yes, there are very specific problems associated with both of those things that are related to our professions. But in terms of the economy in general, what does it say about the economy in general? It actually says a lot of very positive things about the economy in general, okay? And let's talk about what those are. So maybe you don't know this, but there's an inverse relationship between bond yields and bond prices, meaning that the amount of interest that you get paid on a bond, of course, is going to be a larger percentage as the price of the bond drops. So what do people mean when the price of when 10-year Treasury bills or their yields are increasing? It means that the prices of those bonds are dropping. So why are the prices of those bonds dropping? It's because demand for those bonds, the demand for those bonds has the bottom has dropped out of them, right? People don't want them. People just aren't buying them in the volume that they were a few months ago. There's a couple of reasons why. Number one, people really could be concerned about short-term inflation and they want to get out of bonds. I don't necessarily think that's the case. I think people retreated there because of safety. They retreated there because the U.S. government always pays on its debts. It always pays on its obligations. You are willing to buy a 10-year Treasury bond knowing that you are going to get 1.5% interest on it or 1.3% interest, whatever the interest rate you were getting, but you were just happy to get it because it was safe, and you were planning to dispose of that bond when it became advantageous for you to do that, knowing that you might even take a little bit of a loss in order to free up that capital to get back into stocks, to do whatever. Look, rising interest rates here doesn't mean that you're going to see 5% 6-month CDs anytime soon. That would be an indication, something like that would be an indication that we're probably going to see a precipitous decline in stocks. When we see short-term interest rates rise to 5-6% on CDs or something like that, or on Treasury bills, then I'm going to be concerned. But looking at 10-year Treasury bonds at 1.7%, indicating that we're going to see some slight inflation, indicating that there's a little bit less interest in that bond market right now, doesn't really concern me. In fact, it says that there's a lot more confidence that investors have, that fixed income investors have in the market, meaning it means that they may be moving those dollars to stocks. They're not going to be putting it in the banks. They're not going to be going out longer on bonds. They're going to be moving those dollars into assets that can help them keep up with inflation, right? So, and let's talk about other things that are positive in the economy. In fact, Kathy Wood talked about this just the other day. She talked about savings rates for Americans. So savings rates for middle income Americans have basically only increased since about September, to the point right now that they're saving a lot more money than they were pre-pandemic. And there's a lot of pent up demand because economies still haven't fully opened up. Now, the downside of that, of course, is that folks in the lower income stratas, their savings rates have declined because their incomes have declined because the jobs that they held have evaporated because of what's going on in the economy. The good news is that there's a lot of dry powder that people have out there at the middle income levels, which we have a huge middle class in the United States, and there's a huge amount of pent up demand, and these folks are looking to go out and spend money. Like if you look at just restaurant and bar sales here on the West Coast in places like Oregon, Washington, and California, those are down somewhere between 17 and 21% year over year. There's a lot of folks that want to go out and have a drink in a bar. There's a lot of bars that are running at half capacity right now. All that's going to change as we see the vaccine rollout, as we see economies open back up. So the idea that somehow that we're going to see a rise in interest rates and that's going to kill the economy also because these growth companies who are interested in won't be able to finance themselves through debt, I think that's a bit false as well, right? You've seen a lot of these companies over the last year also, as their stock prices have risen, they've taken that opportunity to dilute. They've taken that opportunity to have secondary offerings and to raise money that way. And a lot of these companies have tens of millions, hundreds of millions of dollars on their balance sheets just waiting to be spent to acquire, to expand, to advertise, whatever it is. So I'm calling this right now, and I know this is a really kind of a bold prediction, and it's not something that I like to do, but I think we are sort of at the real bottom here of this correction. It's going to be choppy for the next 2-3 months. And then when we hit May, June, July, I think we're starting the next super cycle in stocks. I really do. And I think it's going to be much broader than it was before. And speaking of that too, if you look at the correction that's happened lately, it's mostly been in stocks that are on the NASDAQ 100. It's mostly been in technology stocks. It has not been in my broader portfolio. Like my broader portfolio is barely down at all. It's just my individual stock picks that are highly concentrated in technology stocks, and everything that I have essentially related to technology stocks. That's what's really gotten hammered. But everything else has been supporting my portfolio and has held up just fine. It's barely down. So I think that we're going to see a much broader advance in stocks. It may be a little bit calmer. I'm thinking that you're not going to see, of course, the 100% gains in technology stocks that we had before. I think it's going to be a bit more sedate than that. But I think it's going to be a broader recovery that encompasses, all of the United States rather than just a few sectors here and there like we've seen. And I am all positive at this point. And I mean, let's be honest, guys. If you watch my channel, you realize that I'm not always an all positive kind of guy. But this is the point right now where everyone else is fearful and everyone else is starting to pull back. That's when I start to get most hungry. That's when I start to get most positive about things, because I realize we are right at the point of really turning around, and we're right at the point of really expanding our economy. I'm not a perma bull. I'm not a stock pumper. I'm relatively calm and sedate when it comes to talking about stocks. I never say that somebody's going to 10x. I never say that you're going to make $1 million on something. But I'm going to tell you something right now. The purchases that you make today are the ones that you're going to talk about 5 years from now. The fact that you held onto your stock today, it didn't sell, that's the move 5 years from now that you're going to know really helped you to reach the level of wealth that you're going to reach eventually. So I think the moves that you make today in terms of selling, you're going to regret. The moves that you make today in terms of buying, those are going to be the stories that you tell other new investors getting into the market 5 years from now. Anyway, folks, thank you very much for taking the time to listen to my rant. I hope you enjoyed it. Tell me how wrong you think I am in the comments below. I look forward to seeing you next time. Thank you very much.